Barbara Stewart just coming off the stage at Nordnet Live here in Stockholm. So Barbara, who is Barbara?
Well, Barbara is a partner and a portfolio manager at Cumberland Private Wealth Management in Canada. Even though we're based in Canada, we do business with high net worth individuals all around the world, and we deal on a discretionary basis. So it's a service designed for people who either don't have the time or maybe they're not interested in managing their own money. So usually they're running their own business or something like that, and they give us the discretion to manage on their behalf. And everything is done on an independent basis. All research is in-house, and we're not bank-owned or anything like that, which is a bit of a rarity these days.
And then I know you also do a lot of research. What field are you in?
I am a researcher specifically in the area of women and money. It's always been a great passion for me, and that's why I'm here today to talk about those trends, and the future of women and investing is what I'll be exploring this year to come.
And those clips will be online at YouTube as well. But coming back to sort of Cumberland and where you work, you have 3 principles of investing. Which are they?
This is all on our website if anybody doesn't get this down. It's cumberlandprivate.ca, and our CEO actually wrote these 3 principles, and I'll just refer to them now. The first one is that values revert to the mean. So all that means, we're familiar with fear and greed, but over time these values and stock prices will always revert to the mean. So it doesn't really pay to get all panicky, as we know. Easier said than done. The second principle is that negativity reduces risk. So this is a bit of a paradox of investing. Just when things look to be the most bleak, there's actually far less risk in those periods of time. And then the third one, and probably the most important, is that liquidity trumps economics. So whenever we're getting all caught up in where are we in the cycle of recession, whatever, that's kind of just data out there. More importantly is where are capital flows going, and if capital flows are going into the stock market for whatever reason, that's going to trump the economic data. That's liquidity.
Very interesting. And now we're in a phase where sort of the macroeconomics is at least trending in the right direction, but valuation of equities are extremely high. So where in this circle, I mean, if you look at your 3 principles of investing, what do you say to your customers, or how do you handle your customers' money?
Well, at this stage in the market, it's like any stage. As far as our firm, we're probably around the middle of a bull market, so there's probably still some money to be made. Even though valuations are high, we feel there's still room for them to go higher. But most importantly, we're going to look for stocks that are value and offer value, so we're not going to be buying individual companies that are priced at those high levels. So I think in this type of market, where maybe the easy money has already been made, if you will, it's going to be even more important for a traditional stock picking type of firm to do well.
And a lot of people watching this will be sort of normal private investors. What can you say to them? What's the most common mistake that private investors do?
You know that animal, the sheep? Yeah. So the chasing return thing, I have to say, nobody ever calls me when the market's going up. I get really lonely, but I get always lots of emails, even from people who say that they want to take lots of risk. As soon as you get a bad day, that's when everybody starts emailing. So I think we always have to be cautious not to get caught up again in the emotion of it, and maybe that's why we're paid to be a discretionary money manager. Probably our best value is that we're trying not to get emotional about it.
To get people to stay away from greed and fear.
Exactly, you got it.
Thank you very much, Barbara Stewart.
Thank you.